Roger, the financial reform bill was recently signed by President Obama. What's your view? Were these reforms really necessary?
In a word, yes. After all, this crisis, the credit market collapse and the overall financial crisis, brought the nation and the nation's economy to its knees and caused tremendous hardship. We have today a 9.5% unemployment rate, a 17+% underemployment rate, and a very crippled economy. And the idea that we might not have addressed the regulatory failings and the other weaknesses in the system that caused all this is not a viable idea. We had to address it. So a financial reform bill was a necessity. I think this one turned out to be relatively constructive.
And do you think that the restrictions, for example, on proprietary trading, risk-taking, you've seen Wall Street develop in directions you probably never predicted when you started at Lehman in the late 60s.
Right.
Right. What happened that really caused these problems? What were the trends that needed to be corrected?
It's difficult to give a short answer to that, but if I could do my best on a short one, what really happened here was a mountain of liquidity which built up in the surplus nations around the world, China, Singapore, and a whole series of other nations which had substantial surpluses. Mountain of liquidity, which was searching for better yields in a low interest rate environment. And so, like water running downhill, it sought out weaker credits because that's where the yields were better, right? The weaker the credit, the higher the yield. And it flowed in enormous amounts into weak credits of all type, the most prominent example of which was subprime mortgages. So it wasn't that subprime mortgages caused this, it was the liquidity and low interest rate combination which caused such a flow of capital into such weak credits and too much investment in weak credits. And a lot of those weak credits, of course, collapsed, and the rest of it we all know.
Do you think we're going to see anything very, very different on Wall Street in the future? Certainly we've seen the Bank of America buys Merrill Lynch.
One thing about Wall Street, it's a little bit akin to Silicon Valley. It's constantly changing, and the shape of and the structure of Wall Street today is not going to be it's not going to be the same 3 years, 5 years, 7 years from now. It's gone through ever since I started. There's been nonstop evolution, and there's no reason to think that'll be different. So it'll look differently a few years from now than it does today. I think you'll see some of the big firms that had big trouble during this crisis fix themselves up, Citigroup, Bank of America, and so forth, and they'll be stronger. I think you'll see some firms like ourselves become larger and bigger factors because we've been growing very fast, and we will continue to, and so will some others. And I think we will see a period of wiser behavior and more prudent behavior in this industry for a while here, because that's always what happens when you have a catastrophe of the type we saw. I mean, the pendulum swings sharply in the other direction, and everybody's focused on being sure something like that doesn't happen again. So I think we're in for a period of stability and a period of prudent behavior.
Do you think that a lot of times financial reform has the unintended consequence of reducing competition and giving an advantage to the big guys? Do you think that that's one of the effects of the bill?
No. I don't think the bill is going to reshape or restructure this industry at all. There were fears that it would, but I don't think that the final product will have that effect.